suddenly RBC is holding an asset that they marked at, let's say, 100 million, and it might actually be worth 60 million. This is the exact type of math that caused the financial crisis in the US in 2008. Canada's largest banks are expecting more declines in the housing market as debt levels are reaching astronomical levels in Canada. You've got these same banks that are laying people off, and you've also got people defaulting on their payments. People cannot afford to pay their bills. So let's get into what is going on here. So it starts off with EQ Bank to cut its workforce by 8% in latest layoffs to hit Canada's banking sector. So EQ Bank is getting rid of 8% of its staff, and this comes after TD and the Bank of Nova Scotia did exactly the same thing essentially, and it's going to cost around $67 million for them to do this. So there is a cost that they're paying, obviously. So you've got to ask the question, well, if everything is so great in the banking system, then why are the banks laying people off? And those are the questions that the financial media isn't really asking. They're just looking at what the banks are saying, taking them at their word, exactly like the media did before the US financial crisis. And in fact, let's go there. Wall Street bloodbath. Layoffs keep growing. This is from November 28th, 2007. So this is before the main apex event of the 2008 financial crisis. And you had Bear Stearns. You remember Bear Stearns? They practically went bust, but they got bought out for pennies on the dollar by JP Morgan. So Bear Stearns is only the latest Wall Street firm to cut jobs in recent months. US banks and financial service companies with banking operations have been slashing tens of thousands of positions. So that gives you an idea of the situation that's going on. When banks are cutting jobs and they are contracting, that is a terrible, terrible sign. Because if you think about the Canadian economy, the banks are at the top of that pile. They are literally benefiting from all the mortgage debt and all the debt that people have built up. And this is insane. So I'll show you this. Canadian household debt showed a slight slowdown but remains lofty. Total household debt rose 0.48%, nearly 15 billion, to 3.13 trillion in August, up 4.45% from last year. Think about that. You've still got debt that is outpacing income growth in Canada. That is the sign of a debt bubble, and it's a sign that we're not at the bottom, and this bubble hasn't completely imploded yet, because still people are able to take on just these ridiculous, mind-blowing amounts of debt. I mean, just think about it. $3.13 trillion. Canada's economy is around 2.28 trillion. I mean, that's... Oh god, it is just so hilarious, but this is what it is. And just take a look at this chart. It has just gone up and up, and you can see the trend. It was down here and it should have gone across like this, but when the bubble started around 2004, that is when you just saw this took off, and it just started accelerating the amount of debt that people are taking on. And obviously eventually rubber meets the road. Eventually people have to pay the piper for all this debt that they took on, because their incomes have not grown at the same pace as this debt. So eventually they can't afford to pay the debt. Then they can't afford to pay the interest on the debt. And we've had that because a lot of people have rolled that into their mortgage as well, with the negative amortization that we saw over the past couple of years. There's been so many can-kicking ideas that have entered into this financial bubble. So Canadian mortgages represent a record 74.5% of household debt. So of all that debt, 3/4 of it are mortgage debt. Mortgage debt now accounts for 74.5% of household credit, the highest share on record. That's a 7.5% jump over the past decade, with the 70% threshold only breached in March 2020. It wasn't even this high at the peak of Canada's last major credit cycle in the 1990s. And you can see what happened there, and we're kind of flatlining in there right now, even though we're at another record high, but you even got to one around 1994 here. So again, it's just kind of showing that where we are right now doesn't look good. And we've got to wait until this starts coming down before you really know that this thing has fully imploded. And then you might be near to some type of bottom in the housing market. This kind of concentration is exactly what regulators warned against. It leaves households overexposed to a single interest rate sensitive asset, which is housing. The risk extends beyond borrowers, presenting a risk to the broader economy and the banking system. Obviously, Canadian mortgage debt concentration amplifies economic risks. So the growing concentration of mortgage debt amplifies household vulnerabilities. Unlike credit cards or personal loans, mortgages aren't discretionary spending. Households can't cut back during a downturn. Both net worth and consumption are tied to a single illiquid asset. When housing drives both debt and wealth, a correction doesn't just hit homeowners, it reverberates across the whole economy. And Canada is already seeing that happen right now. You are seeing delinquency rates that are going up and up and up, and the trends are clear. You are seeing more and more homes that are being took by the banks, and the trend is clear. John Flynn publishes that every month, the amount of power of sales that are going on.
Starting with number one here, there's 13 units. Here we have power of sale. Number 3, power of sale. Number 4, power of sale. No notice on that one. Number 5, power of sale. Number 6, power of sale. Number 7, power of sale. Number 8, power of sale. And we have number 10, power of sale. Number 11, power of sale. Number 12, power of sale. Number 13, power of sale. And number 14, power of sale.
And even the people who are being laid off, even they are saying that, you know, this isn't the end, guys. This is just going to be more and more layoffs that are coming down the pipe, as you can see here. And all these jobs are going offshore, like the Dominican Republic, to save costs. And you basically got layoffs never end. They might be over for some departments for now, but there is always more to come. This has been going on since August on the down low. More layoffs happened today, FYI, and that was on a Friday. Somebody put underneath, I guess Scotiabank doesn't follow the old advice about not firing people on a Friday. And then you've got Canadian mortgages backed by inflated home values and zero equity. And again, this just shows the danger that lies in the banking system. And you can take a look at this. Canadian lenders disregard risk, quietly using blanket appraisals to inflate values, facilitate closing. And this is just the hyper financialization of the housing market when you had all these people that were buying these options, which were assignment sales, and then basically that market just fell flat on its face. And now a lot of people who are going to close, who bought maybe 3-4 years ago, well, they're realizing they don't have the money and they can't get the mortgage. But there are some banks like RBC that are prepared to write up a fake value on the building that doesn't exist so that people can then get approved for the mortgage. But what happens if they default on the mortgage? Well, that means problems in the future, doesn't it? Because suddenly RBC is holding an asset that they marked at, let's say, 100 million, and it might actually be worth 60 million. This is the exact type of math that caused the financial crisis in the US in 2008, and you are seeing very similar things that are echoing across the banking system in Canada. You've seen the negatively amortizing mortgages, you've seen the blanket appraisals, you've seen the mortgage deferrals. What is really left that these banks can do to try and prop this thing up? They're trying everything possible. So basically, that's what's going on. They're still doing the blanket appraisals, and basically you can see this is the amount of homes under construction in Toronto, and still it's just at this huge high right now. So just think about when this supply enters the market. I mean, more and more is entering the market, and guess what? Supply and inventory is at an all-time high right now. Nobody's really buying, nobody's interested in buying, and that is leading to falling prices, and you're just going to see more and more inventory hit the market. And most of this inventory happened as a result of the casino type speculation that was going on with assignment sales.
I think I want my money back.
on houses and condos. I mean, it was just absolutely insane. And then you can see this, a plan that would make Lehman blush, and obviously Lehman went bust during the financial crisis. It was kind of the apex event, really. There's an important lesson from the global financial crisis. Deep-pocketed investors use bankruptcy as a tool to manage liabilities, and normal people try to pay their bills. Having less capital, most assume that mom and pop investors are the primary risk. But history shows us that normal people tend to fear defaults and bankruptcies and will try and make their payments, even through negative equity. And we've seen that happen in Canada's housing market. The primary risk from the financial system's perspective is the party most likely to cause the largest losses, the developer. Blanket appraisals help transfer risk from a large single point of failure developers and redistribute it to lower risk parties, mom and pop investors, first-time home buyers. The plan is literally from the US housing bubble playbook in 2008, where policymakers believe young adults would ride out losses longer than investors. Foreclosures are rare in Canada, but not for the reasons that most people assume. Lenders have a more powerful tool, which is the power of sale. So once again, it's just normal people, average people, that are going to be affected by this fallout when it happens. And you're seeing the risk go from the banks and transfer to average people right now with things like this blanket appraisal. And this is all to try and save the developers. I mean, we've seen the amount of lending that has just skyrocketed over the past couple of years to developers. This is ultra risky loans, and the banks are trying to do everything to save those developers and save the loans because it's a massive amount of money and it eclipses even their profits for the prior quarters. So, you know, these loans going bad, even if it's 10, 15, 20%, that is going to affect their earnings massively and is going to tank their stock. And all these CEOs, guess what? They get paid based on where the stock price goes. So that means they're incentivized to hide this risk from the people investing in the company. And if you look at the case of like the Royal Bank of Canada, it's mostly retail investors that own that as well. So let's put this all together here. After a low rate fueled pre-construction frenzy of mom and pop investors, home prices have made a sharp drop. Lenders are now using blanket appraisals to inflate asset values despite knowing the mortgage may be close to or already underwater. The regulator downplayed the risk, enabling a transfer from developers to small investors, many who are now choosing between bleeding as a cash flow negative landlord or paying out of pocket to exit. That shift also makes debt easier to recover, with lenders able to pursue the shortfall indefinitely. And we've seen that with the guy who supposedly said he had a mortgage on a condo he didn't even own anymore because he had to cover that shortfall.
And it was recently sold on assignment for $590,000. They're now on the hook to cover the difference.
And now I have a mortgage on this property for $300,000 and I don't own it.
And missing payments is becoming Canada's newest national pastime. Nearly 1.4 million Canadians missed a credit payment as household debt climbs past $2 trillion. And this is for Q2. So just wait until we get the data for Q3, which will be in Q1 of 2026. What? I mean, talk about how laggy this data is coming to us. It is completely ridiculous. But you see the food bank lines. You see the lines for people who want to get a job. And they are showing you the depression that is going on out there. And if you don't believe that, then just look at the delinquency rates that are rising. Just look at how many power of sales are happening. It's all there and it's all in the data. If you've enjoyed this video, I would highly recommend this video here. And if you're looking for a VPN and also want to help support the channel, then go to expressvpn.com/marketmania. That's the VPN I've been using for 6 years, and I will see you in the next one. Take care, guys. Bye-bye.